Debt actually means loan. So the money that you are putting with the mutual fund is being used to provide corporate loans, just like banks, just like your financial companies. Here the interest rate will be little higher because these are mostly low duration and short term loans. Loans which are only for few days, few weeks or few months. Here few months itself is called as long duration. So you are not going to find some 20 years, 30 years, 40 years kind of loan tenure here. And these loans cannot be provided to any housing company or anything as such. It is provided to corporate companies for their working capital needs. In short term, they are having some cash crunch. So they borrow the money from this debt mutual funds and accordingly they invest. Now, that's the reason why the returns you will find always as in line with the fixed deposit, little bit higher, as the interest rate what they get is also little higher. Whenever you see high inflation environment, like right now we are undergoing high inflation environment, the returns in the debt funds will be limited. That's why yesterday you might have seen it is only 5%, 6%, 7%. So in a rising inflation mode, the debt funds will give you limited returns, no doubt. So we know that market peaks before the inflation peaks. So immediately after the market peaks, the market crashes, we enter into the pessimism phase. We know that for coming 2 3 years the market is going to remain lackluster. We are not going to get some kind of lucrative returns from the market. That is the time you can park your funds in the debt funds. The returns will be at least double the fixed deposit. The average returns of debt funds is like fixed deposit, but even here also there are cycles. 5 years they give you very limited return, 1 2% less than fixed deposit. Then next 5 years they'll be giving you 2 3% excess to fixed deposit. Overall average return is higher. But if you are choosing the right time to invest in the debt fund, you will make much better than what even fixed deposit could give you. So this happens in the descending inflation environment. So when will you enter into the debt fund? When you feel that, sir, we are done with the high inflation. Now we are going to see the deflation. Now we are going to see the inflation coming under control. That is the time you can invest in debt fund and expect approximately 15 to 20% return per annum. Which is not a great return, but in market it will be 15 to 20% loss if you invest. Compared to that, this is much better. At times it is better to be defensive. You have to be ready to get limited returns. You have to be ready to park your funds in the only 15-20% kind of instrument. Then there will be time to play aggressive T20. Like right now it is the time to play T20. Then there will be time to play even test match. So this art you must know. How to switch the funds according to the market cycle. Then only you will be able to compound your wealth with a very good percentage. So in the high inflation environment, the debt fund returns are limited, while in deflation or descending inflation environment, the debt fund returns are very high. And always choose within short duration, low duration and long duration funds only. Then yesterday I told you we are going to do an exercise by which it will be very clear which mutual fund you should be investing. Point one, you have to keep in mind that at this age we are all youngsters. So we are in 20s, 30s, or maybe 40s. So this is the time to take risk. From age factor also I say that, at the same time from market cycle point of view. So we have to purely 100% invest only in equity small cap mutual fund at least for the next 3-4 years till the time supports. But within this small cap I find lot of funds, see here, and we have seen a drastic change in the returns. So much of variation we have found. So if you do not choose the right fund, though you will make money, but you will not make potential high income. More funds, explore. We found some link yesterday. Where has that gone? Performance tracker. Okay. So you can note down this URL if you wish. I'm putting it in the chat window. You can save it in your system. You don't have to go anywhere else. By default it will be large cap, but what we are going to select is the small cap fund. This is what we want, because we know small companies can grow pretty fast, and that guy who is managing your funds with 40-50 years experience would definitely know which are the potential multi-baggers. Now there are so many funds that I've got. If I don't choose the right fund, I may not make the optimum returns. I want to make the best out of my money. For this is what I recommend you an exercise. So write it down. How to choose the best mutual fund to make optimum returns on investment. First here, it has been found that the maximum returns over long term are generated through equity small cap fund. So first step, list all the small cap fund in the small cap funds performance over various time period. Very simple exercise, but very effective exercise. You have to do this work once in a year. You have to do it once in a year, that's all. Firstly, list all the small cap funds performance over various time periods in the Excel sheet. Let us do it. How can we get that? Here are all the small cap funds because we have selected at the top small cap, so it's only small cap here. Let me see how many of them are showing 10 years performance. Only one. Right. Then what I do? Download the data. So very easily you will be able to download the data in the Excel sheet. Alright. So let me choose 5 companies in this, or let me choose all of them and show you what exactly today. If you want to invest, lump sum or you want to do SIP, which is the best performing fund potential, which could be the best performing fund potentially, that only we would be choosing. The logic behind this exercise is that it has been found historically, since years of data through big data analytics, it has been found that those mutual funds which are underperforming in the short term could be up to 1 year. That means in 1 week, 1 month, 3 months, 6 months, this is not required year till date, 1 year, 10 years, only one. Old mutual fund there is only one, so I'll ignore that. So those funds which are underperforming in the short term but outperforming in the long term give you the best returns in the coming 1 to 3 years. I repeat my point. Those mutual funds which have underperformed in the short term, that means this all should be bad. The return should be very, very low till 1 year perspective. For the same mutual fund, returns should be really good from 2 years, 3 years, 5 years perspective. This small exercise, you do it and you will see phenomenal change in the results. You will be able to get the best every year in your mutual fund portfolio. So just like saying MS Dhoni. MS Dhoni average score is, let's say, 50 runs in 1 day match. Average score in 1 day matches, his average is 50. But one series he did not play well, his average is only 20. Entire 6 months he did not play well, his average is only 25. Entire year he did not play well, his average is only 30. Does it mean that now this guy is not going to perform at all? Now of course that he is off age, but let us talk about 10 years back. So does this mean that this guy is not going to perform at all? Who has given 10 years to our Indian cricket with an average of 50, 1 year he could not perform well? Maybe some psychological issues or whatsoever, physical fitness. But if he is still young, he is still capable of playing, then likely that he will bounce back. That is what these mutual funds also mean. Fund has got a proven track record in the long run. In the short term, they may underperform. See, Wimbledon. So Roger Federer has won a lot of Wimbledon titles. But any particular Wimbledon title, if he loses, does it mean that he is not going to win again in future? He is still the best player. He retired as the best player. So 1-2 series he may not play well, but then again going forward he'll bounce back. Because that's the nature. So every day he can't perform best. There will be some phases wherein you will have to lose. So likewise here also, these mutual funds, they have got an excellent track record in the long run, but due to some problem, maybe that they could not forecast the sector analysis properly, or maybe if the stocks what they have invested is from long term perspective, not from short term perspective, or maybe there was a sudden outflow of the fund. There could be a number of reasons for underperforming in 1 year. We cannot declare that the mutual funds which haven't performed well in the last 1 year are worst. No, we cannot say that. They can still be best. So we want those who have got a long-term track record of giving amazing returns, in the short term who has got the pathetic returns. That combination we want. So the logic behind this exercise is to get the underperformers in the short run but outperformers in the long run at the top of this list. For this, what has to be done? See here. Firstly, we put down all the list of the mutual fund according to the performance. I will only keep what we require. We don't require all that. We are going to invest in direct plan only. Do not go with this CRISIL rank. CRISIL rank they are providing from the short term perspective. So this rank which is 5 today may not be 5 after 1 year. It may be 1. This was 5 which has become 1. This was 4 which has become 3. Do not believe this rank at all, because it is giving you current rank. It is not going to give you the future rank. I'll tell you which can get best rank in the near future. So all the list of the mutual funds have come here along with the performance. Now we are going to do our exercise. What we need to do is, this is the master sheet. In the sheet 1, one week rank. So let me arrange this in the alphabetic order so that it is easy for computation. Alright. So now all this list is according to the alphabetic order. I am copying this and placing it out here. I am only interested in 1 week. I want to know who has performed the worst in 1 week. So what I'll do, cut, cannot change part of the merge cell. From where did this get merged? So cut and place it here. Alright. Now what I'll do is, I'll arrange this list according to the descending order. Sorry, according to the ascending order. So arrangement according to ascending, small list goes at the top. Now this is the rank I provide. So this would be rank 1. Now if you see here, all of these are 1111%. So I'll provide them all rank 1 only. Okay. Now this is rank 2, all of them. Till where? Till here. This is rank 3. Hope you are getting what I am trying to do here. This is your rank 4. This has come recently, that's why you are not able to find anything. So let me assign it as rank 4 itself. Newly launched one. So what I am trying to do here is that whoever has underperformed, I am putting him as rank 1. Who did not perform well in the short run, because that is what I want. I will give best rank to the one who has performed worst in the short term but best in the long term. So this ranking is done for me. So I delete this. I only wanted the ranking. Now I'll arrange this again according to alphabetic order so that computation becomes easy for us. Alright. Likewise, same thing you'll have to do for the next time frame, which is 1 month. So I'm copying this, create a new one, place it here. We don't require the first one, we only want the 1 month ranking. Cut. Okay. Sorry, we first have to arrange. Okay. It's already arranged, right? So within 1 month performance, when I see Union Bank has performed the worst, So what rank should I assign? 1. So is Sundaram. So is IDFC. So is GSP. So is Bank of Small Cap. So like this is rank 2, rank 2, rank 2, rank 2, rank 2. Alright, clear? So any fund which has come recently in less than 1 month and all, you may not find any value, so we'll ignore it. Now this again we want in the alphabetic order, so that we can sum up all of that at the last. So Aditya, okay, okay. So now we can tally this, okay. So likewise, now we do it for 1 week is done, 1 month is done, 3 months. That is a quarter. Copying again. Same exercise. So I'll first arrange this. In this first column, okay, and then take the returns order. So here again A to Z. So the worst performer should get rank 1 according to our logic. So 1, 2, 2. Again 2. 3, 3, 3, 3, 3. Alright. Put it in the alphabetic order. So this is your quarter ranking. Likewise, 6 months ranking. Worst performer gets the best rank. Alright, so this is also done. I'll arrange it according to the alphabetic order. And then we do finally for 1 year. Delete the first row and take the 1 year performance. So I push this in the first column, arrange it. One, two, three, four, five. 6, 7, 8, 9, 10. So this is how the ranking is provided even for a year. Now coming to 2 years, we require 2 years performance, and now is there going to be a change? Here what are we going to do? Descending order. The best performer should get rank 1. So everything remains same, but order what we do here is Z to A. Okay, here there is no performance, so we'll ignore this ranking. We'll start from here. Rank 1, 2, 3, 3, 3, 3. Alright, so this is how the ranking is provided for. So here whatever the last one, 19, 20, 20, 20, 20, 20. Because we do not want to bet on any fund which does not have any record at all. That's why we give them the last rank. So this ranking is also provided now. Likewise 3 years and 5 years. sorry, Z to A, okay? Rank. So whatever is left over there, that is your rank 15 to each of this. Alright, so this also in alphabetic order, ranking is provided finally for 5 years. So we start from here, rank 1, 2, 3, 3, 4, 5, 5. So all this would be rank 12. So now we are done with the ranking of the mutual funds according to alphabetic order. Now simply in the last sheet you will have to club all the ranks. So what are you going to do? Copy. This is your 1 day rank, 1 week rank. Alright. Likewise for 1 month, take only the ranking part. This is your 1 month, quarter, okay. This is a quarter rank. This is the half year rank. This is a 1 year rank. Two years rank. Three years rank. 5 years rank. Alright. Clear now? Let me make this bold. Now this is sum of all ranks. Nothing but equals to sum of this one is to this one. Fine. Now what I do is copy all this, place it in the next sheet. I do not require any of this. I'll have to take it in a static way. So I'm copying this part. Firstly put it in Notepad so that I get in static format. This is the sum of all ranks, okay? Okay, from here I need to do it. Now we want to know who has got the best rank, which is already satisfying our condition, underperforming in the short term, outperforming in the long term. So I select this, put it in the first row, and then make it ascending. So these are the ones. So if today you would want to invest into mutual fund, just choose the top 3 plan. That's it. These are the funds that you'll have to invest. Put your money to make maximum returns out of the mutual funds. So this exercise you will be doing every 1 year. From the day that you have started the mutual fund, every year do this. If your funds still come in the top 3, remain it as it is. But if the order gets changed, your funds may come here at the bottom. Some new funds may come here at the top. What it means, if your funds are coming at the bottom, that means you have made superlative returns, guys. That's why they are coming at the bottom. They have outperformed the best in the short term. So when they have outperformed the best, it is time to exit them. And then choose again the underperformer. Like this churning you will be doing every year. And believe me, your returns in mutual funds will be a jackpot. It is going to be a jackpot. There is a best way, simplest way, effective way, proven way, and very passive way to make best returns. No one does it. Some great fund manager has done research and he has written a book. Through that, we have acquired this knowledge. Already data analytics is done on it. You are now a fund manager, believe me. You are an investment advisor. You are as good as a mutual fund distributor. So today that you distribute the mutual fund, now you can advise which mutual funds to be invested. Just half an hour and you are becoming a mutual fund expert, and believe me, it will do wonders. It will do wonders. You can do this exercise and put it in Excel sheet even if you are not investing, and do this exercise for 2 years and see what is the average return of the mutual fund, what is the average return of the Nifty index, and what is the returns that you would have made, whether it is SIP or lump sum, both. Calculate both of them. I am saving the sheet for your reference. Okay. So this is nothing but I am naming it as mutual fund exercise. Alright. So any doubts in the mutual fund part so that we can proceed with the next step? So okay, note down all the steps. List all the small cap funds performance or various time periods in the Excel sheet. Now in the sheet 2, rank the mutual fund according to the worst performance. Alright, hope the exercise is clear. So this is what you will have to do it every year on year. The day that you have started the mutual fund, exactly 12 months hence, do the exercise. If the same funds come, no problem. If any 1-2 funds come, only those funds, switch it. In IIFL, you have an option directly to switch. You don't have to even sell. Your investment directly will switch from one mutual fund to another mutual fund. Alright. So hope you have understood the entire exercise. Pretty simple. Takes 15 to 20 minutes. And that you'll have to do once in a year. So if you are already doing SIP or already doing lump sum investment, just be deaf. Do not listen to any damn person in the world. Only do this one. You'll remember me after 5 years, 10 years down the line. Now, coming on to the next topic, that is your derivatives, the most complex subject. So what is derivatives? Also called as F&O trading. Also called as futures and options. All are same. The real game in the market is played in futures and options case. But less than retailers do this. Less than 10% of the retailers actively do futures and options. 90% of them only do delivery based trading. They buy a stock, they hold it for some time, they sell it. But in derivatives, the real game is played. Why derivatives is important? Because you can play in both the direction. You can make money when the company price is falling or when the index is falling, and you can win even when it is rising. So let's say that you feel that market is not going to be good for the next 3 years, or let's say for the next 1 week itself. You see that there is some elections going on in America and the markets may fall in case there is uncertainty over the political party. That is your view for the next 1 week. What can you do if you are having stocks? You can just sell them. But in case, if I give you an opportunity that you sell first and buy later, then in fact you can make income. In the market falls also income can be made. That is why derivatives is very popular. The big players play this game. 90% of the big players do F&O and 90% of the small traders do delivery based trading. So whether this should be done or not, it is very risky and you should have an art to do it. It is like leverage, it is like gambling, it is like betting. So if you are not perfect in the subject, you may lose very huge amount, because here everything happens in lakhs. It's not like 1,000, 2,000, 3,000. You have to be ready for either winning 10,000 or losing 10,000. Winning 50,000 or losing 50,000. Winning 1 lakh or losing 1 lakh. But with proper hedging strategies, the odds will be in your favor. Example, I toss a coin and I tell you that please tell me whether it is heads or tails. I say that if you win, I'll give your 1 rupee. For every 1 rupee that you're paying, I'll pay you 3 rupees. But if you lose, your 1 rupee is mine. So what it means is that chances of winning are 50%, but the reward is 1:2. The chance of winning is only 50%. Either the price will go up or it will go down. But if I am right, I should make double profit on my investment. So while you lose 1 rupee, but while you gain 2 rupees. So even if you are right 50% of the time, in total, you should be in profit. That is how the strategies we apply in the derivatives, which is called as hedging strategies. But less than 1% people know what is hedging. And the big game played by the big institutional investors and fund managers with crores of money is nothing but hedging. So to understand hedging, you must first know the foundation for the derivatives. So note down. We will first understand what is futures. or firstly introduction to derivatives. Derivatives are popular because one can make money in both rising as well as falling market. It is only allowed for selected indexes and stocks. Indices. So let's say that for any company I feel that the price from 100 may become 90. So I do not have that company with me. I can still sell it. Where? Only in derivatives. So in my account it will be shown as minus. Let me show you one account straight away because I've already sold some indices and securities. See here. This is I am long. I am like holding it. This is buy. This is sell. Are you able to see? Minus. It shows us minus 70,000, minus 70,000. That is quantity. So you can even sell first, it will be shown as minus, and then later when you buy, this minus will become 0 because you have bought it, it has got nullified. So in case you have sold, you will have to buy it before the expiry date. In derivatives, every company that you are dealing will be having a date along with it. So what is the date here? 24th November 2022. Ignore the CEP, you will get confused right now. So ignore all this, only observe the company name and the date. So within derivatives, always understand that we have got a date attached and you will have to nullify your contract before this date or maximum by this date. You cannot carry beyond it. So whether you feel that the price will rise or you feel that the price will fall, within that date only it has to happen. So let's say that I sold it at 100, price rather than falling, it is rising, you will make loss. Your account balance will reduce within the broker. So as and how the price is rising, the balance will keep on reducing. That is actually a loss for you. Then let's say by 24th November, the price rises by 10%, 100 rupees, what you have sold has become 110. You will have to buy at 110 and make 10 rupees loss. So if it falls, you make profit. If it rises, you make loss. So it is not an easy game. It's a very, very dangerous game playing with fire. Only do it if you are expert. But knowledge you must have. That's why I'm going to cover everything in it. Little confusing. We will go slow. So for now, in derivatives, you have only understood 2 points. That it is only allowed for selected companies. How many companies? We have got 7,000 companies, I told you. But you can play derivatives only in these. The list of the companies here. Not sure. These are the only companies where derivatives is allowed. If you observe, all these are big companies. So you cannot do derivatives for small cap, micro cap, mid cap. Only large cap and blue chip companies, derivatives is allowed. So out of 7,000 companies, the real game is actually played in these companies. Alright. So if I take further, may get confused, tomorrow we will continue with the derivatives part. So 3 points to remember in the introduction of derivatives, also called as futures and options trading. International subject, not just Indian. Rules apply same everywhere. So derivatives can be done only for selected stocks which are allowed by the exchange, approximately 200, and also index. That means even on Nifty also you can do it. Even on Bank Nifty also you can do it, which is nothing but group of stocks. And then you can play in both the direction. You can sell first and buy later. You can buy first and sell later. But whatsoever, it has got a lot size. Like say example here, idea. I can't choose 1,000, 2,000, 5,000 and all. There will be a lot size defined. According to that lot size only, I will have to trade. So here the lot size is 70,000, which is huge. Look at Nifty, lot size is 50. This also minus here. Fine. Like that. So these are the only derivatives contract I have. 1, 2, 3, 4. 5. One more. So here the lot size is 22,500. So this comes with a very high value. Alright. Then we'll see how do we buy, sell, and the transactions. Okay. That's all for today. Any questions or doubts, you can use the chat window or the audio controls.